Welcome to TheoTrade. This is Don Kaufman. It's March 15th, 2024. Just under 40 minutes left inside of the trading week. Degrees of volatility starting to come out of the woodwork here. SPOs are off some 34 handles, and it's triple witching Friday. Look, let's get right down to business here on this weekend's update. Market correlation is causation for concern. I am going to explain that and much more here on this TheoTrade weekend update. All right, to get right into it. So the S&Ps are off some 34. It is a triple witching Friday, as I was saying moments ago. You know, the triple witching part of it, I'm going to tell you, I don't often go too much into detail in any given trading session, but, you know, on this triple witching kind of Friday, wow, the volatility, just as the market was about to open again, that's before the bell. S&Ps were actually trading 52.20. They sold off in a wild and woolly sell-off here right into the opening bell by a fairly steep margin. I mean, you lost 30 handles, and I got to tell you, with like 5 minutes to go to the cash open, it got kind of wicked out there. I mean, we dropped almost 20 handles in about the 5 or 10 minutes before the cash opened. So that was clearly due, of course, to triple witching, and there was trillions of dollars. And I was talking about this on Wednesday night's video. There was trillions of dollars that we knew were just going to expire. Of course, the SPX is a cash settlement. However, you got to unload your hedges to that cash settlement, and the cash settlement was wildly different than the opening price. And that basically, well, a little cause for concern in there. The markets got kind of wild. You know, I guess the interesting and ironic twist to that is right here is the opening bell, and we are from that point massively unchanged. The marketplace has done nothing since the open of this. But again, it feels like right now in the marketplace, we're on the verge of a volatility kind of breakout. And I'm going to show you exactly that. And then we're going to talk about, you know, what is this? Correlation is causation. Look, as I'm going to say time and again, okay, on this weekend's update, looking for correlation in the marketplace is going to be critical. It's going to be instrumental. I've been talking about it extensively lately, okay, and I'm going to explain in quite some detail here in just a few minutes what that really amounts to. But when I say on the verge of a volatility breakout, I think one of the first things that kind of comes to mind today, and I'm actually going to close that up a little bit, look at the tape. So the S&Ps are down, 30 handles. The Nasdaq's actually taken about a 1% hit. Volatility, when you look at volatility, I look at the volatility futures. You might look at VIX. You look at VIX, you go, nothing going on. Nothing going on. The volatility has been, for the most part, lifting, okay, kind of day in and day out. So there's a pretty good lift of volatility for like the last 2 weeks of trade. And we're not exactly at the absolute high of volatility, but we're starting to approach, the 14.5, 15 range in terms of volatility. But there's a lot more going on that kind of meets the eye because, to put this very simply, okay, you realize that like a product like NVIDIA, okay, if I pull up auto expected moves, NVIDIA is actually still up on the week. Moreover, if you take a look at the SPX, the mother of all products, the SPX is literally unchanged at this moment in time. Like if I actually zoom into a 1 day, 1 minute, okay, take a look, that line right there that I'm highlighting, that is literally where the week started. So if the market were to close this instant, we would be unchanged again on the entire week. Oh, how can I call this, volatility? I'll tell you exactly how I can see volatility starting to break through. There are areas of the marketplace where we've seen this like constant rotation, right? So products, for example, like Microsoft, rotate, okay? In fact, we saw a huge rotation in there. You've seen products rotated into like Amazon, and Amazon sitting just, off some of the recent highs over here. Products that have been rotated into, okay, like Meta, not exactly having a wonderful week in Meta, which is outside its expected move. Nevertheless, it's pretty shocking to see the S&Ps even have the capacity to be down 30 with NVIDIA up. And you're probably already thinking like, ooh, I think I know where he's going here with that correlation. No, let's not get there just yet. There are still lots of capital rotations going on. And it's kind of what I call like the rotation game. And I've used that phrase time and again. And that's why I say, market correlation is causation for concern. But you're still seeing the rotation game kind of play out. There's still pockets of strength in here. I'll give you a perfect example outside of NVIDIA, right? NVIDIA, okay, I think everybody recognizes like NVIDIA goes down, it could be some hostile moves, okay? Not only in NASDAQ, but back in the S&Ps, right? But at this point, we have seen days this week where NVIDIA started to see sell-side activity, right? So you just look back just a little bit over here. Oh, there was a precipitous drop. And at the exact same time, you saw a precipitous drop in NVIDIA. They bid it right back into Microsoft. That's what I call the rotation game. Everybody out of one boat, let's jump into another. You're still seeing it go on. The rotation game is still playing out in here. Take a look at stuff like Caterpillar. Okay? Yeah, I've actually asked people time and again, do you have any idea why Caterpillar? And somebody actually gave me like a fundamental answer. Really, a fundamental answer? Stock's actually gone from 220 to 346. 220 to 346. Hold on. That kind of movement, according to implied volatility, would take almost 2 years, right? Yeah, it's 120, what's 120 points amongst friends? It's 672 days. The expected move is only like, 118 bucks. That's how chaotic the move is. By the way, that move is 4.5 months. This move on your screen is 4.5 months. So 2 years of price action is played out in 4.5 months. It's not about fundamentals, not about technicals. It's about rotating into, what's working right now. It's the school of what's working right now. Take a look at stuff like the XLE, the energy sector. You realize that over the last couple of years, pull up a 3-year on here, nobody's loved this product. Yeah, it bid back up coming out of COVID and so forth, but there's been no love. It's not like, it's new highs. It's approaching, some highs. By the way, I'll also kick this off with saying that you do realize that that's incredibly inflationary if the energy sector is actually rallying, which is actually my next bullet over here. It's an inflationary rally. Nevertheless, big break to the upside inside of the energy sector. We still seem to be playing this rotation game. It's one of the reasons that you're not categorically not seeing VIX start to spike. Why? Because we're still capable of rotating capital. And everything will work, until the music stops. It is the game of musical chairs. Everybody get out of NVIDIA and into Microsoft. And literally the very next day, let's get out of Microsoft. And there's not too many places to go to, but we'll kind of buy NVIDIA right now. And they're looking at like Apple and they're like, it's not so bad. I mean, look, it's bad when they're actually starting to buy like Tesla. Nobody's touched Tesla this year, ever. I mean, like, look how many bids this thing has on it. None. There was a brief and fleeting moment when somebody actually thought it might actually bid back up. The point I'm trying to make, Tesla's now down 35% year to date. Ironically, I put on a bullish trade in here because at some point they are going to rotate into Tesla. Nevertheless, though, I wanted to point that out because we're on the verge of a volatility kind of breakout, and it's going to all come in here when that rotation game kind of ends. Now, switching gears entirely, I'm going to come back to the idea of correlation towards the end of this, but, switching gears entirely. Let's go talk about what I term the inflationary rally. One thing that's obviously come to mind quite a bit is, the Fed. The Fed's coming next week. They're coming! Jerome Powell hits the main stage, but there's a difference of this coming Fed meeting. What's the difference of this coming Fed meeting? It's going to be extra special. Now, the difference of this coming Fed meeting is that they're going to update the dot plot. For those of you that have no idea what the dot plot is, I actually pulled up, this is the CME Fed Watch tool. What does the Fed Watch tool do? Oh, it basically handicaps, this is the March 20th meeting. Then we go out to May, by May, by the way, May is not indicating that there's going to be a rate cut. We're out now in June. If you take a look at June, in the June timeframe, this is more like 50-50, meaning that they're starting to indicate maybe in June, there's going to be a rate cut. And I'm going to tell you right now, from my point of view, and this is my perspective, this is going to change dramatically. They're not cutting rates. They're not going to cut rates because what you have right now are assets that are flying. You feel like there's like just nowhere to put your money right now, and assets are flying. Assets flying is completely inflationary. Okay, and moreover, you saw that CPI came out the other day. Now, I'm not going to sit here and talk to you about CPI for the next 20 minutes. It's worthless. Whatever. The data already came out. What did the market do, though? Okay, CPI came out, and that is, it's inflationary, right? And it came out hot, which means more inflation. Inflation might be making a comeback, and inflation's going to make a comeback. What did the marketplace do? And, you could look at this time and time and time again. I'll tell you exactly what the marketplace did. Okay, on an inflationary reading, it rallied. And it didn't just rally a little bit, it rallied huge, huge by huge, okay, on a hotter than expected inflationary reading. And of course, people are going to come up with, different ideas in that. The bottom line is, okay, the Fed, and the reason I'm actually being the Fed strikes back, the Fed has a few mandates. Obviously, interest rates or whether they're capable of achieving those mandates by changing interest rates or not changing interest rates. The Fed has a few mandates. But the primary mandate, okay, look, let's keep people employed and let's keep inflation down. They have a big problem though, because asset prices, okay, and a rally in the marketplace is inflationary unto itself. If you feel like you have a lot of money out there, boom, that's inflationary. Okay, you might have a big issue this Fed meeting, this next week, okay? Again, it's not one of the mandates of the Fed to come in there and say like, asset prices are ridiculous at this point. And other than like, Alan Greenspan that talked about irrational exuberance, that's how Alan Greenspan talked markets down to some degree, and irrational exuberance not only in the housing market, but of course in the in 99 and 2000, in of course one of the biggest asset bubbles of all time, the internet bubble. Nevertheless, okay, I think they have a huge inflationary problem over here. Do not be surprised to see a dramatic change, okay, dramatic change in what is going to be the dot plot, where people are expecting, just a few weeks ago, people are like, oh, there's going to be 6 rate cuts. And maybe there's going to be 3 rate cuts. Now you're looking at, people are going to be talking about maybe 1 or no rate cuts. Okay, markets could get a little fear put into them. All right, so I call that kind of the Fed strikes back. But again, I actually, from this meeting, do expect quite a bit out of Jerome Powell and crew, specifically the dot plot change and the Jerome Powell hitting the main stage doing his press conference after, of course, which is Wednesday afternoon. And we'll all be glued to the screens right then and there. Speaking of which, it is interesting to look at the SPX. Okay, forget about looking at a chart. Go out and take a look. Obviously, to the end of next week, you have about an $82 expected move. Ironically, that's exactly the expected move this week. But, okay, implied volatilities, they're already starting to amp up in the latter portions of the week. This is Wednesday, Thursday, and Friday of next week. There's about a 14 vol. That is really going to start to pick up because, again, anticipation is building for that dot plot to come out. In any regard, that's the big player in the room, of course, next week. You're going to find out really quick that inflation might not necessarily be a bullish aspect to the marketplace, but the Fed really does have a big problem on their hands. As long as the market rallies, they do not, unequivocally do not have inflation under control. And yes, I am absolutely unequivocally relating asset prices in the S&Ps to inflation because, again, they really are joined at the hip. All right, moving on past, inflationary rally, the Fed strikes back. Let's get to bonds. So we have, again, the Fed coming out. But we also have a little bit of what I would term some risk in here, almost the perfect storm, if you will, because what you're looking at inside of the bond market presently, all right? We can look at bond charts till we're blue in the face. You can actually pull up TLT. TLT actually does a pretty good job. I use TLT from time to time because I think it's easier to interpret. TLT, all right, is the ETF for the bonds. But here's the bottom line, okay? We're sitting very close. First of all, we're sitting very close to yearly lows, but we're right coming up to a critical threshold in this marketplace. Moreover, if we bring up TNX, TNX is the 10-year, again, it's the 10-year interest rate. You'll understand now by looking at TNX, okay, even more effectively, of what I kind of term the perfect storm here. Look where TNX happens to be right now. So coming into a Fed meeting, right? It's of no surprise. You're looking at this and you're saying like, all right, we're coming into the Fed meeting. It's like 4.3%. Okay. This could absolutely explode. If the Fed turns around next week and says like, you know, I guess I call the Fed punks to Tawny Phil. They actually see their shadow. More winter. Anyway, no rate cuts anytime soon. That 10-year could absolutely explode to the upside. And this is where, again, there's a lot of people that are going to turn around. Don't worry, man. I have AI stocks. Interest rates don't matter. And they're going to say that going to be very, very scary at that point because you're going to find out real quick. Of course, interest rates matter because eventually the consumer stops spending, and some of the consumer sentiment numbers have not been spectacular, right? At the same time, inflation is creeping back up and the consumer is creeping back down. Now think about that in a little bit of a catch-22. You're just not feeling it yet. Why? Okay, because everybody loves NVIDIA. Speaking of NVIDIA, this thing just went into a nosedive in just the last couple of seconds as I am recording this. Sweet. Anyway, bonds are actually portraying almost the perfect storm in here. Keep an eye on TNX, okay? A little bit before the Fed meeting, I'm going to be looking at this, but during the Fed meeting, I mean, again, a straight shot even to 4.5%, that is going to put a hurt back into technology now, okay? The title, of course, of this weekend's updates, you're kind of looking at it, you're like, market correlation is causation for concern. I'm basically saying market correlation, okay, it's everything right now. What I want to bring to you is, look, where are the S&Ps right this second? Doesn't matter what you think, doesn't matter what you think about the marketplace, whatever, it's going to close in a moment. S&Ps are almost down 40 handles. Now, let's go look at the advanced decline line. You realize the advanced decline line isn't that bad. There was actually a point in time today where the advanced decline line was basically 50-50 and the S&Ps were down about 40. Okay, and you're thinking about that, you're like, ruh-roh. You realize that if we actually go into any correlated state here, which is what we need to see, you want markets to kind of normalize. You guys do remember that markets used to go higher and from time to time go lower. If you're going to start to see, quote unquote, two-sided trade, it's going to come hard, it's going to come fast, and it's going to come with heavy degrees of correlation. If you really want to know if volatility is here, and when I'm talking about volatility, the marketplace, okay, has had a strong bid under it effectively since the beginning of November, right? And it hasn't looked back since the very beginning of November. There's been a few, blips on the radar screen, but I think the best way to portray this, take a look at the SPX. In the SPX, there has been since literally late October, beginning of November, there is one breach of expected move to the downside in the very beginning of the year. It was only a 4-day trading week. It was right in the beginning of the year. We've had nothing but upside, absolutely nothing but upside. Markets have not been very two-sided, which should make you nervous. The other aspect that has not actually occurred, we haven't seen great degrees of correlation. Okay, if you're looking for like volatility and a confirmation of volatility, look for, again, heavier degrees of correlation. What am I talking about? And I was talking about this on the Wednesday video as well. Look at like 90 products, if you will, trading to the downside. And the reason you got to be a little concerned right now, and you're looking at this, I'm not really concerned. No, you should be, because you have a marketplace right now that's down, only 0.7%. It's down listlessly. But you realize there's 32 other products in the S&P 100 that can be sold, okay? And the products that can be sold, they're pivotal. They're pivotal products. Again, you got stuff like NVIDIA that's up, okay? Boeing is up and Caterpillar is up, okay? Intel, it's flat, and JP Morgan, look at the financials, okay? Speaking of the financials, I didn't even go into this, but the financials, right? They haven't seen sell-side activity in what? Whoops, swing and a miss. You missed the financials. Financials, okay? Absolutely blowing the doors off any returns that you've ever seen in this product. I've been trading the financials, well, okay, pretty much since the ETF came out. Absolutely spectacular move. Even in other moves that were spectacular in the past, and this is a move in 2020, right? Coming out of the COVID crash, there were at least pullbacks. There's no pullbacks right now. Okay, and that's what makes actually this bid under the marketplace. This is a 5-year weekly. That's what makes this bid under the marketplace so incredibly dangerous that you're starting to look at it and you're like, oh, I kind of see what he's talking about. The S&Ps are down 40. The financials massively unchanged on the day. You start getting the financials playing a role in sell side activity, the energy sector playing a role in sell side activity, you got yourself problems. Okay, the advanced decline line kind of looks like it's down, and you're seeing a bit of a rotation right now out of some of the tech stocks. Okay, but the biggest, the 800-pound gorilla in the room is flat, massively unchanged in the trading session, and all of your financials are flat to higher, and energy, okay, is rather what? Mildly higher on the day. Okay, as I was saying, that's where I'm saying like correlation is causation for concern. All right. And it's just a little bit of a play on words, but correlation is going to be the sign. You see high degrees of correlation, you're going to really put a hurt into this marketplace and damage it. So be really, really careful. The last thing I'm going to say on that front, okay, is that volatility is being sold and sold heavily by trading firms. And if volatility is being sold by trading firms and we start to go into high degrees of correlation, okay, those trading firms are going to have to go out, they're going to have to buy the volatility, and the VIX will actually start to accelerate and explode to the upside. And that's some of the risk you're going to take. All right, last but definitely not least, the mother of all products, the SPX. Look, if we closed, as I said moments ago, if we closed right this second, for the most part, yeah, we're down on the week, but really we're unchanged. If you look at the QQQ, take a look at the Qs on the week. Where's the QQQ? It is lower on the week. So this is actually 2 consecutive weeks where you're seeing the Qs close the lower edge of expected move last week. The Qs actually down again this week. A hint of sell side activity in the NASDAQ. But as I said, it's not a correlation. The whole marketplace needs to get hit as if it were one. But inside of the SPX, we just came out of a week with an $82 expected move. Okay, put on your big boy pants. $82 is pretty good. We did not hit the upper or lower edge of an expected move, right? This next week of trade, what are we expecting the next week of trade? Well, this is where things get interesting because, again, we had CPI this week, but this next week, enter the Fed, $83 expected move. So, and again, that's not settled yet. You still have 15 minutes left in the trading session, 15 minutes after the close, and I will actually provide over the weekend the exact expected move. But the bottom line is this. We just went through what we construe as a heavier week of volatility. Guess what? You're in store for another one. You're actually going to have a marketplace that's going to be rocking this next week. And I actually think volatilities are going to pick up quite considerably, okay, pre-Fed, because everybody's going to come to the same exact conclusion as I just did. They're going to look at that and say, holy crap, we're not correlated. Holy crap, what if they change the dot plot? Everybody's going to come like to this conclusion. Probably by Monday or Tuesday, volatility is going to start to pick up. So hands and feet inside of the vehicle at all times. We're ready to rock next week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.